My name is Raphael Bostic. I'm the Interim Director of the Lusk Center for Real Estate. It's my pleasure to welcome you here to our annual Casden Real Estate Economics Forecast, where we will review the market in multifamily for the years to come. It's really a pleasure to be here. I always enjoy this event, and it's particularly gratifying to be here because this is sort of a coming home for me. When I first came to USC from Washington, D.C. when I was working at the Fed, this job was my job. My job was to direct the Casden forecast and get it off the ground. It was a lot of work, it was hard, and creating an infrastructure was quite difficult. But over the years, the center has really taken the forecast and grown it in ways that I just would never have imagined, or could never have imagined. It's really a source of pride for me to be here and to see what it's become, and see all of you here to join us and make this an event worth attending and talking about. I do want to particularly call out the leadership of the Lusk Center. Over the last few years, you're going to hear from Richard Green in the second panel, but I do want to emphasize just how much and how important he's been to the progress of the center. And so, Richard, I really appreciate all that you've done. Now, we're here to talk about housing, and multifamily housing in particular. And this is a topic that in recent years has really captured Los Angeles and actually the nation as a whole. If you turn on the radio, invariably you're going to hear someone talking about what's happening in housing markets. If you open the paper, and if you open today's paper, you saw a lot written about housing and multifamily. This is an issue that comes up repeatedly. And it's also an issue that's come up nationally. So for those of you who don't track affordability in markets across the country, we have been doing some work with the MacArthur Foundation and RAND just to try to understand whether the challenges that we're seeing here in Southern California are challenges that are unique to us or are more general. And the answer, the punchline, is that this is a problem that's hitting every market across the country. We looked at over 300 metropolitan areas, and affordability has become more challenging in more than 300 of them. And so this is an issue that is real for people across the country, and is something that people are talking about. Now, this attention to housing and this concern about it has actually brought out a bunch of advocates and community members. And I do want to say that there are things going on here in Los Angeles from a policy perspective that we all should be paying attention to. There's a Build Better LA initiative that will be on the presidential ballot in November. There's a Neighborhood Integrity initiative that will be on the ballot next spring. There are issues in Santa Monica and coastal communities. All of these are proposals and potential actions that have real implications for this industry and for how people live in Southern California. And it's important that we all make our voice heard in those conversations to make sure that we move forward. So it seems everyone's talking about housing, and I do think that that reality is what makes this program so important and so timely. And so I'm really grateful for the people who have really helped us put this together. And I wanted to first thank the staff of the Lusk Center. You all have engaged with them, you interact with them. They do a great job. That nothing in this program would happen without them. I want to give particular thanks to Marilyn Ellis, who has been managing the production of the report itself, as well as the logistics around this program. The staff is great. I enjoy working with them, and please join me in giving them a great thank you. I also want to thank our partners in this. In your program, you will see that we have a number of sponsors as well as program affiliates. I wanted to just call each of them out specifically to acknowledge our great thanks for their partnership in putting this event together. We have two sponsors at the gold level. The first is the Center for California Real Estate. This is actually a new center that has been established by the California Association of Realtors to really promote research and thinking about real estate markets. The center itself is a new sponsor for us with Casden, but the California Association of Realtors is a longtime partner, and we really enjoy working with them and are grateful for that. A second gold sponsor is Heffernan Insurance Brokers, the real estate practice. They have been a long-time supporter of the Casden Forecast, and we're really grateful for their continued support for all that we do here. Without them, this wouldn't be nearly as big and as in-depth an analysis as we're able to do. We have 3 silver sponsors. We have Barry Slatt Mortgage. They're new to supporting us, and we are grateful to have them on board, and hopefully this is the beginning of a long relationship with them. We have Mac Urban. They have been supporters of us in the past, and we're grateful for that as well. And then we have NNC Apartment Ventures, and they have been with us for a long time, and we're really grateful for their participation and partnership. We have 3 program affiliates. These affiliates have really helped promote the program: the Apartment Association for Greater Los Angeles, the Southern California, Los Angeles, and Ventura County chapters of the Building Industry Association, and CREW LA, the Commercial Real Estate Women of Los Angeles. And I really do thank all of you for helping make this program as successful as possible. Let me say a few more things before I stop talking and we get onto the forecast itself. First is what we're going to do today. We're going to try in our first part of today's program to introduce the forecast, to give you a high-level summary of what we are forecasting for the next couple of years. And then we will have a conversation, I will have a conversation with Chris Thornberg and A. Martinez about the housing market. If you listen to KPCC at all and the Take Two program, you'll know that Chris and I and A and Dalia Fernandez periodically have conversations about what's happening in local economics. So we're going to recreate that to an extent here, and we enjoy it, and we hope that you will as well. After that, we'll take a quick break, and then we'll have a conversation about gateway cities and growth patterns in gateway cities. They are particularly important as we think about the region's economic performance and its ability to continue to create jobs. And so how housing is provided in those markets will be quite important. That conversation will be moderated by Richard Green, who I mentioned before. And then I'll be back to wrap it up, and then we will send you off for the rest of your day. So let's start with the forecast. We tried something a little different this year. So we found a partner, Beacon Economics, and asked them to help us produce the report. And Chris will talk a little more about that, but this report is really different from previous reports in that it really draws upon a different data source than what we've done in the past. And so as you look at the statistics, they may look a little different from previous reports. The trends are not so different, but the specific numbers are. You'll get more clarity on that in the next hour or so. But to present the forecast, I'm pleased to have Chris Thornberg here to do that. He is the founding partner of Beacon Economics and is also the director of the Center for Economic Forecasting and Development at the UC Riverside School of Business Administration. Chris has been a long-standing voice in forecasting the regional economy and housing markets, and is widely respected both in the industry and in policy spaces. In 2015, he was named to California State Treasurer John Cheng's Council of Economic Advisors, and he also serves on advisory boards for Paulson and Company and the LA Chamber of Commerce. He has a PhD in business economics from the Anderson School at UCLA, and we overlook that for these things. And he has a BS in business administration for the State University of New York at Buffalo. Please join me in welcoming Chris Thornberg.
Good morning. Thank you. Actually, I've known Richard and Raphael for years. Obviously, when you're in this kind of space, you get to know people around you. I've always enjoyed interacting with them when they called us up and said, hey, I want you to help us on this forecast this year. We were thrilled. And so I'm very excited to be here and kind of give you a high-level overview of what we're thinking for the multifamily space, particularly here in Southern California. Now, a little different, as you're going to see in my presentation. Look, you got numbers. You got all sorts of numbers in the book that was sent out to you, all sorts of things for you to look over. I'm going to try to give you a high-level picture because I think if most of the people in this room, you're probably worried. You're worried about the stock market. You're worried about bubbles. You're worried about interest rates. You're worried about the global economy. You're worried about cap rates. I can go through the list of worries that are probably on the tip of your mind. Obviously, real estate is an enormously cyclical industry, and everybody's constantly on edge. When's the next business cycle going to occur? How bad is it going to be? What does it mean for my bottom line? So to start out today, the conversation for today, I'm going to introduce a word. It's funny, we did all sorts of numbers for this, but words are my friend, and I love words. And this is the best word. I found this word not too long ago, and I think it sums up so well where we are as an economy, and that word is miserableism. Now, miserableism, mind you, is technically the philosophy of pessimism, or as I like to put it, trying really hard to convince people that things are bad when they're really not, okay? And we are in a particularly nasty spat of miserableism in the U.S. economy in this particular point in time. Now, miserableism isn't necessarily a bad thing. Some people make very good livings out of miserableism. Here are some of my favorite miserableists. Everybody remember Morrissey from back in the 80s, right? He was a big miserableist. Anybody over 40 gets that? Anybody else? You're like, who? Louis C.K., he's a little more modern, right? There's another big miserableist. I like to point out that the stock market is also a big miserableist. They love bad news because bad news drives volatility, which drives trading, which drives commissions, which drive profits. So they're all about the miserableists. And of course, if you're feeling really insecure right now, it might be because at this particular point in time, there's been a sort of a herd of miserableists running across the nation, namely these people, who are all explaining how our lives are totally terrible and they have the solution. Well, not these people anymore. Well, actually, not these people anymore. But these 5 people are quite convinced that they have all the solutions to your particular problems, as the case may be. Look, forget all the nonsense. Just forget it. Just forget it. Here's the reality of the situation. Look, no matter how you slice it, with ups and downs in the markets and all the craziness you hear in the news, the U.S. economy is functionally in the middle of an ongoing mediocre expansion, period. Look, you cut through the numbers, right? 2015, actually a pretty good year. Not great, but a pretty good year. Labor markets continue to be strong. There is no financial bubble in our market at this particular point in time. Housing is still in recovery mode in many ways. Credit's starting to expand. Commodity prices are down. Somewhere in the middle of last year, I had this kind of crazy situation. Suddenly the stock market, which has always assumed that expensive oil was bad for the U.S. economy, suddenly decided that cheap oil was bad for the U.S. economy, which I never really understood, to be perfectly honest with you. It's kind of like your grandfather. Remember, he had to walk to school 5 miles each direction, uphill, in a snowstorm, 365 days a year. That's kind of where the stock market is right now. And California, by the way, far from being the economic disaster like Greece or Detroit, as people were predicting in 2010-11, we're not lagging the nation, we are leading the charge. This is by far and away the biggest job-creating machine in the nation right now. Now, it isn't to say there are not problems out there. Of course there are. You got, it's not a particularly happy expansion. It's relatively slow growth. State and local budgets are still stressed. Yeah, China's a bit of a mess. Bad financial regulations, pensions, entitlements, inequality, gridlock. I get all that. And while we should be focusing our attention on these particular issues, here's the good news for the next couple of years. Not one of these issues, as bad as they are, will create a recession, period. And what that means is we're going to continue along for the next couple of years in good, solid economic growth. And that's the biggest thing you need to know. At the next couple of years, you're going to continue to have a good environment for building and renting out units, as simple as that, particularly here in California. But with that in mind, there is a big change happening out there, particularly in the multifamily space. And it all boils down to this. Over the last few years, because of the big wave of foreclosures and the clampdown on credit, we have seen an unprecedented movement of households into rental space, and it has created one of the biggest apartment bull markets you've ever seen. Last few years have been nothing but fantastic for the space. It is coming to an end. There's no doubt about it. It is starting to slow. Look, we have a strong labor market. Mortgage credit is starting to ease. There's clearly demand is shifting back towards owner-occupied space, And of course, on top of all that, at a national level, we're starting to see a record amount of new supply coming online. That all suggests that the big apartment bull market is absolutely coming to an end. But the question is it going to plateau or is it going to collapse? Is there pain on the other side of it? And the answer is it's a plateau. It's a plateau at the national level. Because while it is true that we're starting to see the swing back towards a more traditional mix of demand, that is to say a lot more people wanting to own their homes rather than rent, that shift is going to be slow. Credit is loosening, but historically still very tight. Millennials are growing up very slowly, and they're not in any particular rush. And of course, on the demand side, we'll come back to that in just a second, there's another supply side, rather, there's another big consideration, which is, of course, the demand for single-family owner-occupied units that's going to come from the current stock of single-family rentals. And then last but not least, there's little sign of any kind of major, what I would call pricing problem in the market, and that, of course, will also be a balancing factor. That means, of course, that the multifamily space is still a good place to be, but it's going to be a little tougher than it was 3 years ago. 3 years ago, you could pretty much lob money in any project and you were going to make a buck. Today, you're going to have to be a little smarter. Got to work a little harder. You want to focus on rapidly growing economies and population bases. You want to look for places that have supply constraints. And of course, you want to watch out a little bit for the high-end market, because remember, the high-end part of the market is where people tend to slough off and go to the single-family owner-occupied. But guess what? None of these issues apply to Southern California. Indeed, if you're talking about places where there's rapid economic growth, Southern California. If you want to talk about places where there's a lack of supply because of supply constraints, that's Southern California. So in a sense, you are already in the right market for what's happening in our economy today. So where does all this optimism come from? Let's just start with the GDP numbers. Last year we grew about 2.4%. That was a headline number. That's output. I like looking at final demand. That's the growth in consumption by consumers, by businesses, and by the government. That was 2.86% last year. That's the best year we've had since 2010, a very solid year. So very positive numbers here. Consumer spending added almost 2% to the economy. That's a big number. You say, well, hey, I thought retail sales were really weak. Retail sales are nominal. We're in a very low inflation environment right now. The real numbers look much better than that. Business investment outside of structures was very good last year. Exports, we keep hearing how terrible the world economy is and the fact that the dollar is up so much. That must be horrible for exporters. Exports grew in 2015. That's how solid our manufacturing base, that's how competitive our exporters are, that they can deal with a slowing world economy and a high dollar and still export stuff. And of course, state and local government is also starting to pick up their spending. They're finally pulling themselves out of their financial hole. The big negatives here were really threefold. First of all, were imports. With consumers spending a lot of that stuff came from the rest of the world. That's why the trade deficit opened last year. And of course, structural investment, non-residential structures, that all wraps around one thing, mining, and of course that has to do with the commodity glut, particularly in oil. But otherwise, for the most part, all systems go. Employment continues to move forward, adding over 200,000 jobs, about 2% growth last year. Real incomes continue to grow about 3% on an annual basis, year-on-year basis. It's a very solid number. It's more of the economic growth, more of the economic gains in our economy are going to workers now as opposed to corporations, which is a nice shift to see. Unemployment continues to fall. I always love this debate. What's the right unemployment number? What's the wrong unemployment number, as the case may be? Because you'll see the headline number and then the U6, which includes discouraged workers. Well, the answer to which one of these is right or wrong depends on who's in the White House. If there's a Democrat in the White House and you're a Republican, the top line is right. You got that, how it works? And the bottom one's wrong. And vice versa, of course, if there's a Republican in the White House. Look, these two numbers have a correlation of 0.98. They move basically completely together. And to look at one or the other and say one's right or wrong is wrong. Here's a key point. They're both falling. And while it is true participation rates are relatively low right now, most of that has to do with changes in the demographics of our economy, namely boomers moving into older years where participation rates naturally fall. Honestly, our labor market is looking very good right now, and not, I wouldn't call it 100%, but probably 95% back to normal levels of overall job creation and income creation, as the case may be. Now, talking about the labor force, I do want to have a brief conversation, a little tangent, because it's important for the housing conversation about what I'm calling the Millennial Myth. Every time I turn around, I'm involved in some sort of conference where we have to sit around and talk for hours and hours about how important the millennials are. Now, listen, if you're wondering, I am a Gen Xer, and I am bitter as a result of that because I'm trapped between the spoiled millennials and the spoiled boomers, as the case may be. But pushing all that to one side, I'm really tired of hearing about the millennials. Obviously, the young generation, they're coming up. I realize that the vast majority of their ability to communicate comes through text messages. But putting all that to one side, honestly, from a demographic perspective, they're not that big of a deal. They really are not that big of a deal. Because we don't have a population pyramid. We have a population kind of column, as the case may be. Millennials are almost functionally the same size as Gen Xers on a year-by-year basis. And so to constantly think about the millennials from a housing standpoint is incorrect. In fact, if you took some of the census numbers and said, where is the biggest population going to be, growth going to be over the next 20 years? It's not millennials. It's not the young people. The middle there is the change from 2015 to 2025. The census is expecting about 26 million people. Of the 26 million people, 18 million, 75% of them, are going to be in the 65-plus range. Really, honestly, when you start thinking about housing and thinking about changes in our economy, it's still about the boomers moving into the retirement years. That is the biggest change on the block. Millennials, you're talking about an 8 million increase in 25 to 44-year-olds, only 10%. Not that big of a number. The next 10 years, just as dramatic, with, again, the 65-plus accounting for 13 million out of 23 million new people, well over half. So you're thinking about housing, you're wondering about changes in demand, that is the biggest number out there, and that's what you should be focusing on. Credit's starting to expand nicely, both consumer credit as well as outstanding consumer debt, largely because the mortgage markets are starting to expand again. Should we be worried about consumer debt? Not at all. Right now, because of declines in interest rate and deleveraging in the consumer market, the debt servicing ratio, that's the percent of household income being used to support current financial obligations, that's the lowest it's ever been. And remember, the big problems we had in that consumer credit cycle back in 2007, 8, and 9 was never about the quantity of debt, it was about the quality of debt. Subprime credit card loans, subprime auto loans, subprime mortgage loans, which of course are the worst of the worst. Today, the problem is the exact opposite. Credit is not too loose, it's too tight. If you look at the overall credit score at origination for mortgages right now, the median credit score for somebody getting a mortgage is 750. 20 years ago, it was about 700. So very, very constrained markets, which of course has really been the defining feature of what's been happening in terms of our housing market. And what is happening in the housing market? Well, last year was a good year. It wasn't a great year. It was a good year. About 5.5 million sales overall. It's getting back to kind of normal levels. Nothing compared to that 7 million number we hit back in 2005, 2006. Prices continue to expand. Indeed, they accelerated a bit in 2011 relative to 2015 relative to 2014. Overall in the U.S., you saw an increase from 4.3% year on year to 5.4%. Hottest markets out there, still on the West Coast, a little bit in the South. Portland, Seattle, San Francisco, Los Angeles saw about a 7% increase in prices over the course of the last year or so. Have prices gone too far? They haven't gone far enough. When you start thinking about the housing market, you have to start to recognize that we are still in what I would call recovery mode. One classic indication of that would be basic housing affordability. If you look at the cost of a house today, controlling for interest rates, look at it compared to household income, turns out homes are still incredibly affordable from a long-run standpoint, even though we've seen increases in prices. We're only coming off this ultra-low level. And in terms of construction, back in 2005, we had a vastly too rapid pace of single-family construction. Today, it's still under 800,000 units annually. That's a very, very weak market. We're still far from recovery. And that, again, all goes back to the credit constraints. All those new rules that were put into place, which basically hold banks responsible for anything that can go wrong in a loan, has largely shut off the credit supply to low credit score people, which has functionally slowed down the recovery. This is what we call the law of unintended consequences. You know, in theory, these rules are supposed to help lower income, low credit score households. Quite the opposite. It hurt them by preventing them from being able to get into the housing market at a time of record affordability. Be careful what you wish for. But things are starting to improve. There's a couple big keys out here. On the left-hand side, this is one of my favorite graphs of all because I think it tells such a wonderful story. It's change in households. And you can see that big surge back in 2005, 2006. That big surge in household creation occurred. Think back in time. This is when your 23-year-old proudly announced to you and your spouse, Mom, Dad, I just got my first subprime mortgage. I just bought my first house, and I'm going to be a housing millionaire any day now. And then about 2 years later where that collapses, that's where your now 25-year-old, after being foreclosed on, is moved back into your basement, okay? Now that has been relatively flat for a while, but it is starting to pick up. Household formation is growing, and at the same time, household vacancy rates are starting to fall. Housing demand is going to be strong, and it's going to be a driver of overall construction, but the big question is, where is the demand going to fall? For the last few years, because of credit constraints, it's largely been in the multifamily space. It is going to start shifting back to the single-family space, to the owner-occupied sort of space. Again, higher incomes, better financials in the housing market, all held back largely by credit constraints, but credit is starting to loosen again. The FHA is getting back into action. On overall, you're starting to see credit scores rise as people fix their financial situation, and there's a little bit of increase overall. Banks are becoming a little bit more comfortable in lending in this environment. So it is starting, but again, it's a relatively slow process, which of course brings me to apartments. Apartments, again, have been really benefited by the credit constraint. You can see rents have been rising very dramatically nationally. Overall vacancy rates have fallen to very low levels, running to 4 to 4.5% according to some of the data out there from one of the big providers. This is already starting to top out, and it's of course going to be influenced even more by the fact that last year we saw a record number of starts and permits for multifamily properties. It's a huge new supply coming online. Obviously, you're dealing with a situation where the market's going to get a little bit oversupplied. But there's going to be an offset. And the offset, of course, has a lot to do with, well, I'm coming at the offset in just a second. First of all, let's talk about what that means. Right here on the right-hand side is a little bit about ownership dynamics. I'm comparing 2005 to 2014. I'm just assuming for a second, let's assume that we go halfway back to the ownership rate we were at in 2005 on an age group by age group basis. Moving back towards own home ownership, how many units, how many rental demand products would end up leaving the market? And the answer is about 2.2 million. So that's a pretty significant number of people leaving the space, as the case may be, as we expect over the course of the next couple of years. But will that mean that we're going to have this big glut in the market? And the answer is no, because of the single family situation. You know, one of the big dynamics in our housing market over the last 5 or 6 years has been, of course, investors moving into the single-family space. This is a comparison of renting households in 2008 to 2014. About 5.5 million new renting households over that 6-year period. Well over half of those people ended up in single-family rentals. On the left-hand side, I'm showing you kind of a long-run picture of renters in single-family housing going back to the 90s. Of course, the last big housing cycle we had was late 80s, early 90s. And what you can see in that period of time, there was a big increase yet again in single-family rentals, and then when the housing market got hot in the late 90s, there was a big decline as investors sold those properties back off into the owner-occupied market. We're already starting to see that very similar dynamic this time, and remember, we're talking about 2.9 million new single-family rental markets. If even half of those shift back over to owner-occupied space, that more or less accounts for most of the decline in renters we see in the U.S. economy over the course of the next couple of years. So that's the good news. Plateauing because of this balancing effect of the single-family rental markets. We think things are going to be pretty good. What about here in California? Well, the first thing to remember about California is how good this economy is. It's funny, I was on a panel a couple of years ago. It was a bond buyer panel, and there was an economist for Standard & Poor's in New York, and she had this question for the panel I was on to ask. She said, looking back a few years, everyone was saying California is going to fail like Greece to Detroit. Things look different now. What has happened to turn things around? And what I started out with was first pointing out that not everybody said that. In fact, that's kind of a silly thing to say. Look, do we have a business-unfriendly economy? Yeah, we do. Do we have high taxes? Not really. We have stupid taxes. It's a little different situation. But putting all that to one side, yeah, I get it. We make it very difficult to do business in California. Guess what? Doesn't matter. See, that's what's funny is we built this mentality that somehow or the business climate is a defining feature of which economies succeed and which economies don't. That's not true. It's simply not true. California right now, since the Great Recession came to an end, has been growing like gangbusters. Right now, over the course of the last year, we added 450,000 jobs. That's 2.8%. That's the 8th fastest growing economy. Over the last 20 years, we've added 30% to our payroll workforce, which is one of the fastest growing economies out there. Now, Texas, of course, for the last bunch of years, has been growing faster in California. That's constantly we're being held up to as a point of comparison. But the real question is how much of Texas was business friendliness and how much of Texas's success was oil? Well, the news, of course, is shown here at the bottom because right now Texas is the 29th fastest growing economy. They slowed down to about 1.4% growth on a year-on-year basis. It turns out it was largely oil that was driving the hot Texas economy. Now, Texas is going to be fine. They're a diversified economy. Oil doesn't mean to them what it used to. And they're going to continue to chug forward because it is a solid economy. But it's not about business friendliness. In fact, in many ways, Texas grows so much faster than California because of housing. What do I mean by that? Well, let's get a little farther into what kind of jobs, where are they? It's a broad mix, different parts of the economy. Labor markets, again, unemployment falling across the board, good solid numbers here. But the biggest issue California faces is housing. You know, right now in our state, we're seeing about a 3% growth year on year in the payroll workforce. Very solid numbers. The labor force is growing about 1% per year. Huge gap. Now you can have jobs growing at 3% and labor force growing 1% when you have slack in the labor market. In other words, unemployment is high and falling. But right now, California is getting very close to full employment. The unemployment rate's down to about 6%. There's not that much slack. And if our economy wants to continue to grow, the defining issue we need to deal with, of course, is expanding the housing stock to allow more workers to work here. Well, that's the last thing we do. In fact, this state has been constantly undersupplied for housing for years and years and years. And as a result of that, of course, prices are high here relative to the rest of the United States. And then, by the way, that affordability gap is growing tremendously over the last couple of years. You can see right now, U.S. housing prices about $220,000. In the Bay Area, they're over $600,000. Here in Southern California, they're well over $400,000. The gap is a function of two. We have one of the worst overcrowded housing situations, one of the lowest vacancy rates. What's funny is California is still affordable when you account for those low interest rates, but in our own extremely unaffordable sort of way. So again, there's no bubble in housing. This is just housing returning to its standard sort of supply-constrained, artificially high prices, as the case may be. And guess what? We're still not building enough. Here's the numbers that are in California at this particular point in time. And you can see single family is still very depressed. We're building 14,000 per month. Now we're building less than 4,000 single family. The multifamily has come back. Right now we're seeing a little over 4,000 per month right now. But if you say, well, is that really that high from a long-term perspective? Not that high. It's high, but it's not hugely high. And indeed, if you look at the overall growth in the stock, given permits over the last couple of years, take Los Angeles. You're only talking about a 3% growth in the multifamily stock. And of course, with almost no single family coming online, you're still seeing a situation where the state overall is adding about 4 new people for each new housing permit we're pulling. That's an incredibly low number. In other words, the housing shortage is only getting worse as our economy continues to grow and continues to increase. And that is going to, of course, be the big driving, supporting situation for the multifamily. Why don't we build enough? CEQA, Prop 13, simple as that. These are problems that are well understood. CEQA, California Environmental Quality Act, which allows every NIMBY from here to Timbuktu to fight tooth and nail against any kind of development. We're seeing it all the time. And then, of course, Prop 13, which is often neglected. Prop 13, of course, is a property tax that functionally limits the financial value, particularly of multifamily for local governments. We have to think about that. If you sit down with local government and you say, hey, you got 40 acres of land, what do you want to do with it? Well, the first thing they want to do is retail. If they can't do retail, they'll take commercial. If you can't take commercial, maybe I'll go for single family. And the last thing I want is multifamily. Because from a cost-benefit analysis, the tax base is low and the cost of the services they use are high. And I constantly argue that. I mean, the whole split roll idea. They want to do a split roll. Let's get rid of Prop 13 for commercial. By the way, that was just going to make the situation worse. It's a terrible idea. The problem here is Prop 13 makes it unwieldy. It's unwanted by local governments. And nobody's talking about fixing these. In other words, nobody's talking about actually fixing our housing shortage. So what about the outlook for the multifamily? Again, you got this big document in front of you, all sorts of numbers. We cover something on the order of 36 regions, including the big 4. The data does look a little different. I'll tell you why. You know, the data you're typically used to seeing is survey data collected by some of the big commercial real estate companies. What we have done in this data is actually pulled data on the American Community Survey, which is out of the census, and it's based on the actual housing stock. The rents you'll see, for example, are rents paid, not rents asked, and because it's a much broader, including older and smaller units, the rents you're going to see are much lower than in some of these older reports you've seen. As for the model itself, we were very careful of how we set this up. We drove the permit activity drove increases in supply. Demand, by the way, is driven largely by incomes and employment. That's the biggest driver of housing demand. In fact, it's funny that we're having all this conversation about affordability today. Affordability was actually much worse in 2010 and 2011 because unemployment was so high and so many people had limited incomes. Affordability for apartments is better today than it was in 2010 because incomes have come up faster than rents have. So in a sense, because there's a strong market, that's what's driving rents in there. And then ultimately, of course, when you look at the rental prices, it's driven by vacancies, it's driven by these income numbers. And overall, what you're seeing, of course, is we see vacancy rates stabilizing. They've been falling very sharply, but there is some new supply coming on. And of course, some households are moving back to owner-occupied space. What that means is vacancy rates are stabilizing. They're not coming up, but for most markets, they're stabilizing. The overall lack of single family and rising prices means it's a slower move to ownership here than in other parts of the United States. That's a stabilizing influence. Rents will continue to rise, but they're rising largely because of rising incomes, because there's simply more job opportunities and more incomes in our state at this particular point in time. Obviously, there's strong sub-regional variation, although we are starting to see better results in what I would call some traditionally lagging regions. And that, of course, has to do with the fact that the dense areas, you're starting to see more push out in terms of overall permits to some of these, like I said, traditionally underserved areas. The biggest problem, of course, is one of affordability, or perhaps better stated, the perception of affordability. In fact, if I said, what is the biggest problem that we're going to have in our rental markets and our multifamily markets over the next couple of years? Well, Dr. Bostic already pointed it out, and that's the political atmosphere. Because right now, in this sort of supercharged political environment, there are all sorts of standard political backlash, or rent control issues, inclusionary housing issues. Obviously, you're dealing with these new statutes that's trying to limit building. All the typical NIMBY rent control kind of pushback. Ultimately, these sort of policies will only make the housing situation worse, not better. And that for me I think is the real shame, that we don't have real conversation about real policies that can help the situation. Instead, we just indulge in these kind of failed but politically popular, if you will, programs, which is too bad. But again, what it all means, the lack of supply means that this market will continue to be one of the stronger in the nation, even if it's slowing down just a little bit from where you've been over the last couple of years. Now, last but not least, I'd be incorrect without talking a little bit about cap rates and the overall idea of a bubble, because I know that cap rates are relatively low in the area. Is this a bubble? Have asset prices gone too far? Well, and by the way, I should say this out loud. Back in 2007, I was relatively well known for having talked about the housing bubble and the potential economic consequences, which of course came true. Today, I'm completely in a different camp. I don't think there's an asset bubble. And the reason I don't think there's an asset bubble is asset prices today, as much as they've come up, still make sense given low interest rates. Remember, go back to your old finance class. You had that one question. You have an asset that gives you $100 per period forever. Interest rates are 5%. What's the value of the asset? And you go, I remember this formula, 100 over 0.05, that's $2,000. Interest rates are up to 4%. What happens to the value? Well, okay, 100 over 0.04, $2,500. Lower interest rates mean higher asset prices. And that's the equilibrium I'm moving into. And by the way, interest rates are still low. Interest rates were not pushed down by the Fed policy. They were not pushed down by central bank policy in other parts of the world. Interest rates have been pushed down over the last 30 years because of the global capital supply glut. That's what savings glut. That's what Ben Bernanke first talked about when he first got in the office all those years ago. He didn't talk about the Great Recession. He didn't talk about housing. He talked about the global savings glut, which today, by the way, is worse than it's ever been. There's massive amounts of capital flooding into the world market, coming from China, coming from boomers, coming from pension funds. There's so much money out there, and in that kind of environment, returns are going to be low. Interest rates are going to be low. Makes it tough. It makes it tough for the business person, but on the other side of it, it also keeps the cost of capital nice and low as well. And then, of course, there's the real economy. What's interesting about the concept of financial markets is financial markets by themselves cannot create recessions. So even if you thought the unicorns were highly priced and the value of unicorns went from $1 billion to $500 million, it doesn't matter. Because unless there's real imbalances in the real economy, financial prices can go up and down without much of a change at all in the economy. Take the stock market. Stock market's been all over the map lately. The stock market, you don't even pay attention to the stock market. There's an old quip. Paul Samuelson, Nobel Prize-winning economist, once famously said that the stock market has predicted 9 of the last 5 recessions, which is about right. Because there's a major sell-off in a recession, but there's always one major sell-off between recessions. There's like 1987, Black Monday was a classic case of that. We've had 4 major sell-offs since the Great Recession came to an end. 4. The market's out of control. I think it's high-speed trading, but it doesn't mean anything anymore. Ignore it. By the way, stock market should be high because corporate profits are high. Forward-looking PE ratios, that's 20. That's pretty good. Relative to interest rates, the spread is pretty good. And by the way, American companies have no financial problems. Debt-to-equity ratios in American companies are very good right now. There's no issues there. Cap rates have been falling, sure, but guess what? Cap rate spreads relative to your bonds, nice and steady. And by the way, they're tighter here in Southern California, largely because rental growth has been better. No risk factors, no dangerous buildup of leverage, and that's for the Federal Reserve itself. Well, this is probably the best explanation of federal funds rate I've ever seen. Turns out federal funds rates are all driven by the height of the chairman. So you want interest rates to keep falling, you just need a shorter chairwoman, that's all. But putting that to one side, forget the federal funds rate. You know, I like to say the federal funds rate is like the Kim Kardashian of financial news. It gets tons of press, and when you get right down to it, it's completely irrelevant to your life. Totally irrelevant. Look, the federal funds rate, the spillover to a 10-year bond rate is like 8-1. If they raise the federal funds rate a full percentage point, you're talking about a 0.15 increase in the 10-year bond, and that's what's important to you as a borrower. So it's just not relevant. Interest rates are low because inflation's non-existent, because there's too much supply of capital out there, and they're going to stay low for a while. And again, that's supporting the financials. Like it or not, those prices you're paying are reasonable in this type of economic environment. So that's the big picture. You're in a good place. The market is slowing down, but it's going to be nice and stable for the next couple of years. And with that, I think I should turn it back over to our wonderful host. Thank you very much.